Hi, I'm Adam Carlini. With me is Grant Haddon. Behind the camera today is our other team member, Gary Luna. We are Dynamic Wealth Management, and this is our market update for November 5th, 2019. It's been pretty decent weather,
Right.
It's warm here, comparatively speaking. Cooled down pretty sharply, and then it's popped back up. We're sorry for those of you who are still not back in Arizona. Most of our snowbird clients are back. For those who are Washington National fans, congratulations on your World Series win. First time I've ever seen where the home team didn't win a single game. It was the visitor every time.
Yep, first time ever.
Yeah. There's some changes going on in the economy with interest rates. Federal Reserve now has lowered interest rates for 3 times over 3 months after raising quite a bit before. The rest of the world's still cutting interest rates. I'm sorry, they're cutting rates too. So we did start back up about a month ago, our investments for breakfast. We do that at 9 a.m. on Tuesdays, every other Tuesday. We had one today, so our next one will be in 2 weeks. We also, this Friday, were invited to speak to the investment club at Sun City Grand. So we'll be speaking there this Friday at 1. We'll be talking about what to do when a loved one is ill or dying, so you're prepared for when that happens. There are lists and things that you need to be aware of, as well as strategically tax preparation type things and investment strategies that would make sense. So we'll talk about those kind of things then. Our next Breakfast Club,
November 19th.
Grant's presenting.
Yeah, so I'll be talking about the models that we run here at Dynamic Wealth Management, just kind of giving an overview of what we do and what our strategy is to manage money. So we invite you to come to that and bring your friends. It's a light breakfast. It's not salesy. We're just going to talk and educate. So please come. That being said, the market is near all-time highs and has been doing very well this year after the drop into the end of last year. But we're at all-time highs and a lot of things happening in the economy. So let's jump in the video and are into the markets and tell you what's going on.
Sounds good. And our upcoming events, we're speaking this Friday at the Sun City Grand Investment Club at 1 p.m. Again, that's what to do when a loved one is ill or dying. These are checklists of things you'll need to be aware of. And it's good to be prepared in advance because there are also strategies that you would want to take advantage of while your loved one is still living, and other things that would be important for you to know. Breakfast Club, investments for breakfast. The next one will be in 2 weeks on November 19th, and following that December 3rd. Those are again at 9 a.m. So our model is still showing bullish. We are actually up to new all-time highs. So we've got a little further cushion before we would go neutral again. And so that's where we're at. We're bullish in all of our core ETF models, meaning that the portion that's invested in equities is a full portion. Looking at some of the key events recently, some things that have helped the market to do this, as we mentioned earlier, interest rates. So they've lowered interest rates now 3 times in the last 3 months. They said that they needed to kind of recalibrate things, that this was not the beginning of a big interest rate cutting cycle again, since we had been raising rates before that. And so Neil Kashkari, who's the Minneapolis Fed president, basically said, hey, we're on pause now and not expecting any more rate cuts the rest of this year or any time in the near future, as far as we know. That, however, is in contrast with where their target is. The Fed's target is eventually at 2.5%, which means we need to rise to get there. And their previous year-end estimates, this is what they were suggesting. Now this is pushed out here to 2020, 2021, 2022. So they're suggesting that things are going to rise in the years until they get to that 2.5% rate. Although the market right now is suggesting that actually we will see rates drop further without any more federal cuts, just because the economy is beginning to slow down. And the global economy has slowed down to such an extent that we have negative interest rates in many parts of the world now. You can see here historically, a yield curve is usually steep like this. This is a normal yield curve. The longer out you go, the higher the interest rates you get paid. And you can see that was December of 2013. Now, October 31 of 2019, look how flat this curve is. It's not steep at all. It's very flat. Now, this was flat out here before, but notice from 10 years in, notice how steep that was compared to how flat it is now. And in fact, before this rate cut, the big fear was that we were going into recession because this curve right here was starting to invert, where you had higher rates at the low end than you did out here in the longer end. Now with these recent cuts, you can see that a 10-year bond treasury is paying almost 1.7% versus 1.5% for a 1 year. So that's more healthy, but even at the 5-year point, you're getting a little bit less right now in a 5-year than you are in a 1 year, suggesting again that things are slowing down. So by lowering interest rates, they're trying to keep this expansion going a bit longer and stave off the recession. We've been in this now 10 years, so I don't know how much longer they can stave it off. We'll see. Looking at where countries are at in this process, China is already in the contraction part of the curve, whereas Germany and Italy are getting close to that. Their economies have slowed down substantially. The UK, bothered by the whole Brexit issue, has also slowed down significantly. France, and here's the US, and then Brazil and Spain. So overall, you can see we've gone through the recovery, we've slowed down, continue to expand, but at a slower and slower pace, headed towards contraction. And so how much longer we can go here before we contract to the point of recession, we'll see. The Federal Reserve will continue to be active, they say, if things get weaker, to try and cut, but their expectation is not to do so now for a while. So with that, we'll turn the time over to Gary to give you our charts review and further stock.
All right, good to be with you folks. This is Gary Luna, and we will go ahead and start talking about what's going on in the stock market and looking at some charts. What we're looking at is the last 6 months of the markets, and you're looking at the 4 major financial markets between bonds, the US dollar, stocks, and commodities. So as you can see, as we talked about before, interest rates have done very well as far as going down. And so that means that there has been a demand for bonds. And you can see that in this chart, that over the last 6 months, bonds have been the best performing financial market, up almost 5%, followed by, of course, stocks, but stocks much more of a volatile ride over the last 6 months, and just at about 4.5% on the S&P 500. Notice that the US dollar, even though it's slightly positive over the last 6 months, has been fairly strong. We have seen large cap stocks do better than small cap stocks because of that. And we've seen, you can see here, it's kind of hard to see because you have so many lines, but the US dollar is usually at an inverse relationship with commodities. And so as the dollar strengthened here, you see commodities generally go down. As the dollar has weakened over the last couple months, you see commodities have picked up. And so overall, we'll see that you see that bonds and stocks have done fairly well. So if you've been watching the markets, some good news is that as we finished out last week, we did hit new all-time highs. This is the S&P 500. The Dow and the NASDAQ also followed suit. The one index in the U.S. market that has not is small caps. Again, so large caps have done better than small caps, and it was nice to see the market finally break out of this level that we had been at over the last several months. Every time we got near about 30.27, 30.21, the market went back down, and so it was nice to see us finally break out of that level. We would expect to see the market take a pause and break back down. Probably that would be likely. But the idea is we would like to see the markets hold this area and, of course, continue to stay around this area so that we can move forward and hopefully continue to do well as we go forward here. So as we look at the market over the last 6 months, let's break it down in different asset classes. So here we're seeing the S&P, the Dow, the NASDAQ. We're seeing small caps. We're also seeing, wanted to compare with international markets. So we're seeing the major developed index. Compare that to the emerging markets, U.S. dollars, commodities, REITs, and finally treasuries. So as you look over the last 6 months, not hard to see that, at least as far as stock markets are concerned and equity markets, the U.S. market has generally outpaced most major economies out there and has done better than most developed countries. We also see that developed countries have done better than emerging market countries, with emerging market countries generally negative. So relative strength has gone to the U.S. market, as our economy has been relatively stronger than most economies out there. Here's the strength in the U.S. dollar over the last 6 months, and commodities generally being weaker, especially in the area of energy, which we'll see here in a second. Good news is that real estate has done fairly well. REITs have had a good run over the last 6 months, mainly due to probably lower interest rates that continue to be a boon for most parts of the country as far as real estate. Definitely here in Arizona, we're seeing that trend as there's a lot of building going on. And finally, as we talked about with bonds being in demand and rates going down, that has been good to hold any type of bond, especially treasuries. Treasuries up almost 7% in 6 months. Wow, that's unheard of. That's not something that we normally see. But as interest rates have gone down, that has been good for anybody holding any type of bonds. And that's one of the main hedges that we use in some of our ETF portfolios. What about sectors? These are the major sectors, the 11 major sectors in the S&P 500. So if you go across the board, where's most of the strength coming from? Well, technology has done okay over the last 6 months, as well as some utilities. Also, we talked about real estate, staples, healthcare, financials. They're all positive, as well as materials, which is a good sign for the economy. The one that has been the laggard is energy, mostly because of oil. But you also see discretionary and communications down, industrials fairly flat. So that's kind of the breakdown as you look at the different sectors. So in our model allocations, what does that all mean, and how do we translate all this information into actually allocating real clients' money across their different types of accounts? Well, as we talked about before, we are definitely still in a bullish area, even though there's a lot to point at that worries us. The biggest things being still the trade wars with China and the potential for a slowing economy, as has been noted. Still, the markets are, again, hitting new all-time highs, and we are still in an uptrend. And the way I would summarize all that is, if the markets were concerned, at least in the short term, with a recession anytime soon, we would not be hitting new all-time highs. If the markets were really concerned about what's going on with the political environment, with the elections coming up and with impeachments, or the possibility of an impeachment, then we would not be hitting all-time highs. So we do not feel, in our opinion, that the markets are very concerned about those things. Again, the main things, trade wars and slowing economy are still probably number 1 and 2, and we'll see what happens with interest rates going forward. So in the meantime, we continue to be bullish, and the trend is still favorable, meaning that we are still in a risk-on green allocation, and this gives a good idea between our clients that are in our ETF trend-following model, between our growth, modern, and conservative clients, action that we will take if we break down and go into a yellow zone, which eventually will happen, and eventually we will go into a red zone. That's the tactical approach that we will take in this particular model. In a sector model that we have, this is a breakdown. So the difference between the model that we saw prior and this one is this one reacts on a quarterly basis, and we pick out from a universe of about 17 different sectors and industries, and we take the top 8 that are ranked based on recent performance and volatility. So you can see, for what it's worth, some of the areas that we are currently holding, as we still have a couple months to finish out this particular quarter. With that, that closes out our update for today, which is Tuesday, November 5th. We thank you for watching, and we would appreciate any feedback. Also, if you'd like to contact us, we would love to sit down with you and review your personal situation at no cost to you. And we would do a thorough estate, tax, and investment plan specifically suited for you and your goals, your risk tolerance, your time frame. And it would be an honor for us to do that. With that, we'll go ahead and close out this update. Thank you very much for your time.